All right, so next part of our module here on risk management, we're going to take a look at a way in which we can analyze not only the risk, but also the performance of a stock, but measuring it against a what we're going to call a benchmark. In this case, we're going to use the S&P 500, which is the standard benchmark that most investments are measured against. But again, we're talking about managing the risk that is present in investing. And while it sounds simple, yes, the risk is that I could lose my investment. We have to think about what type of risk am I also facing and what type of risk am I also managing. The risk of losing all of my money. We talked about last time about diversifying our investments and spreading our money across multiple asset classes in different sectors and industries. And so today, what we're going to look at is something called or referred to as market risk, where the risks associated with obviously being in the market. In the market, we mean the stock market, but also the risk associated with just how the stock market operates and how it is kind of an independent, it's kind of its own living, breathing thing. And while majority of the times the performance of the stock market is positive, there are times when obviously the opposite happens. So when we talk about risk, we're thinking about too a deviation from what is expected, sometimes an unwanted and unpleasant deviation. And so this could obviously happen in both the short term and the long term. But when we expect something to happen and there is a deviation from that, there is risk present, even just the potential for a deviation from what is expected. If I'm driving down the street or if I'm driving to school, the expectation is that I get there safely. Risk is a deviation from what is expected. If I get pulled over, if I get into an accident, or something happens. So anything that deviates or kind of wavers from the expectations. So the first thing we're going to use today is analysis or is a number called beta. Beta represents the tendency of an investment's return to respond to swings in the market. When the market as a whole moves, does the security move to a greater or lesser degree? So think about, yes, the stock market. When we say the market, again, oftentimes we're referring to one of those benchmark indexes, either the Dow Jones or the S&P 500. But for these, we're going to look at the S&P 500. So as the S&P 500 goes, does it move to a greater or lesser degree? So when we're looking at beta, we define the market as 1. And we'll get into the calculations of this number for the individual investments here in just a moment. But if something has a beta of 1, that means that it moves to the exact same degree in which the market does. And we'll look at some examples here in just a moment. If your stock or if your mutual fund has a beta that is greater than 1, that means it moves more than the market. The beta for example, a beta of 1.2, it means the security is 20% more volatile than the market. Now, it's kind of a general way to describe it. And like I said, we'll get to some calculations here in your assignments. Less than 1 means it moves less than the market. Okay. All right. So what does this actually look like? All right. So you can see on your screen here, we've got a stock chart of 5 different investments. Okay, so we'll start with the thick black line there. That is the S&P 500. So that is our standard index that we're using. So we really can't talk about beta and then later R squared unless we measure it against some standard or some benchmark. So again, in this case, it's the S&P 500, the broadest measure of overall market performance. The thin blue line there represents Costco. The purple line is Apple. Red is Verizon, and the green line is Walmart. So just take a look at how, and this is over a 1-year period, just take a look at how these stocks are moving or when they are moving compared to when the market is moving. Right? So remember, the market is 1. So that thick black line, the S&P 500, that represents a beta of 1. So looking at these, do we think which one of these stocks has a beta that is greater than 1, closer to 1, or less than 1? Okay. Well, Costco, again, in the blue line, it is less than 1. So it is less volatile than the market. Okay? Now, there's many reasons, obviously. Costco is one of those defensive stocks that, despite some movements in overall market activity in the economy, Costco tends to do pretty well. Even more so is a company like Walmart, where their activity is not, or their movement in terms of gains and losses is not as great as the overall market. And then we have one even lower. We have Verizon, which you can see on the bottom there is pretty stable throughout some significant ups and downs. Now, in cases, back in March when everything was down, yes, certainly we were going to have those once in every few years, market collapse. I don't want to say a collapse, but market corrections. But for the most part, you can see Verizon has been pretty steady. Okay, now let's take a look at Apple. Apple, again, you might think people are going to need iPhones. It's a stable company. But Apple moves about 20 to 30% more than the market does. And you can see, if you look at, around here in September, certainly we had the market increase. We had a spike in market activity. Okay? But look at the spike that Apple had. So it's not necessarily that when the market moves, it doesn't move, but look how much more it moves than the actual market. Okay? So that is beta. But here's one thing that's important. Lower high beta simply measures the size of the move a security makes. It does not mean necessarily that the price of the security stays nearly constant. So if it has a beta of 1, that doesn't mean that it doesn't change. Or if it has a beta of 0, that doesn't mean that the price doesn't change. It just means that it doesn't move with the overall market. Okay? All right, so the next one is R squared. R squared is reserved for mutual funds. Now, the nice thing about mutual funds is mutual funds have a beta and they have an R squared. So we're going to use both of these. R squared represents the percentage of an investment's, in this case mutual funds, movement explained by moves in the overall market. So how often is the investment moving in the same direction as the market? So if an investment has an R squared of 100, then 100% of the time it would move in the same direction as the market, which again typically would be reserved for some of those exchange funds or those ETFs that are trying to mirror the overall market, the S&P 500. Okay. So here's another example here. So we have, again, the thick black line is the S&P 500. The blue line represents a mutual fund, ShapeX, which is a predominantly stock mutual fund. They invest in large and mid-cap companies. And so you can see, even though the return at the end of a given time is different, the movements of this mutual fund are almost lock in step with the overall market. Compared to the red line there in the middle, which is another mutual fund, but it mostly invests in fixed income, which is bonds, we don't see nearly as much movement. And in fact, for the most part, the line is pretty flat compared to our other two investments. So stop to think, what would we expect, or what would we think about the beta and R squared for these funds? Okay, so remember, the market is 1 when we're talking about beta. And if you can explain the movements of the fund 100% because of the overall market, then that would be represented by 100. So not surprising. ShapeX has a beta of 0.92, which is almost 1, and it has a R squared of 98. So the reason why the fund ShapeX is moving is because of the overall markets. Okay? On the other hand, this mutual fund, again, mostly fixed income, some real estate and some bonds, and some credit swaps, has a beta of 0.1 and has an R squared of 1.28. So there is almost no correlation, or there is almost no explanation connection between the overall movements of the market and the movements in this fund. Okay? So when assessing an investment's risk, it's important to look at both its beta and R squared. Beta is more meaningful when it's accompanied by a high R squared. So again, R squared measures how closely each change in the price of an asset is correlated to a benchmark. Beta measures how large those price changes are in relation to a benchmark. Used together, R squared and beta gives investors a thorough picture of the performance of asset managers. Okay. All right, so what you're going to do once you're done with this video is you're going to head over to Google Classroom. You'll see your assignment posted for today, beta and R squared. After watching this video, you can click on that Google Doc. Now, the first part here is just kind of a review of some things from the video, so if you want to take some time to read over that. But then we're going to get into, all right, how do we actually calculate the beta for a company? Or, I'm mistaken, not the beta, but how do we calculate what would be the expected change given a beta number and also a performance of an index, in this case, the S&P 500. So it takes you through an example here of how to calculate it. And so the first part here, this is just some practice. And then you'll follow this formula, you use this formula, and you'll calculate what is the expected increase or decrease of these stocks given the beta and also the change of the S&P 500. Now, on the bottom here, you'll see this is blank. This is where you're going to pick some stocks from your portfolio. And so you can go to Yahoo Finance. If you go to the summary page on Yahoo Finance for any stock or any mutual fund, it has the beta number on there. So let's pick a stock. Let's go back to Walmart. Okay, so I can see here on the page right here, it tells me that the beta is 0.44. So again, I would go back here, I would fill in the beta number and the cost per share, and then I would go ahead and follow that formula to calculate what the expected increase or decrease would be. And then the next thing, so let's go to mutual funds. Same thing. If I go to the summary page, I can see here there's the ShapeX fund that I showed you guys in the video. Here's the beta. Now, to find the R squared, I'm going to click on the risk tab here, and you can see here, this gives over a 3-year period, which is fine. We can just use this one, an R squared of 98. Again, 98% of the movement in that portfolio is because of movements in the overall market. Right? So the second page is doing some mutual fund research. So you can fill in the information from the two funds that we researched. And then if you have mutual funds that you're interested in investing, I know we can buy funds in the simulator. But you can enter them here, or if you purchase mutual funds in the $1 Million Challenge. Either way, let's try to find a couple mutual funds to research, find their beta number, their R squared, and then what would be their expected fund year-to-date change.